Okay, I think all systems are go here today. Lecture 25, right? This is our sort of last, I guess, new content lecture of the semester because next time we have our big exam review, and indeed, just to show you what the heck. Just to remind you of the data here. Last class is coming Thursday. That's our review, right? Our exam is a week following that. The time is officially 11:30 to 1:30, so it starts a little bit later. You have 2 hours. I know I've said this before, but I'm saying it again. The same length as usual, with that little caveat that that I might add a couple of questions to the in-class component. Other than that, the online component will be as before. Yes, there is an online component. You'll have a couple of days to do it, starting on the exam time and date, right? Of course, I have a little bit of time to tell you how that's going to work or remind you how it's going to work next time. I almost forgot to bring down my hard copies of the practice exam again, right? But miraculously, I was able to take an elevator upstairs, get them, and be back in class for the start of class. So I do have hard copies. Don't hand them to me, by the way, after class. Keep those, bring them home, use them to study. If you want to, you can upload them to GradeScope if you want them to be graded before our review on Thursday, right? And to upload those, my preference, of course, is that you write on the actual exam sheet itself and try to match as closely as possible the template, right? Otherwise, things don't line up and things get graded wrong and all of that stuff. But it's low stakes. You don't have to do it. I guess I could say it's no stakes. You don't have to do it. It's for your practice and enjoyment, and we will be going over all of it next class, right? There also is an online component out there that's going to open up at 1 o'clock today. That's practice also. I think you have until 5 a.m. on Thursday to do it. My logic there is that at that point I have to shut it down and grade it and get it back to you so I can use it for the review in class that day. Oh, I also added a new problem set, so now we just have the two since the last exam. Problem sets 10 and 11. I believe both of the due dates are the 20th. I can't give you that much additional time after the exam because I have to get your grades done and into the system. So that takes a little bit of time and thinking. A number of you have asked about extra credit. Once again, the chapter questions are extra credit, right, in the book. So they're all interlaced through all the chapters of the book. You can start at chapter 1, right, and work your way through chapter 20 and do those questions. What I do is at the end of the semester, I just kind of see what fraction of those questions you've done well, right, not necessarily correctly, but you've made a good faith effort at. And then I use that to make an extra credit grade. How much is it worth? Depends a lot on where you are in the class, right? If you think you have a D or something, well, then you can get a lot of kick out of the extra credit. If you have an A already, well, there's only so far you can go, right? So it depends a lot on these things. Intuitively, once again, it's my chance to kind of look at your, students always say, well, I studied hard, I read the book, and then I bombed the exams. I don't know what happened. It's my chance to at least sort of check on whether or not you've done one of those things, right? Which is, read the book. So there's that. That's kind of what I have in mind in assembling the extra credit. Okay. Right. So to give you a very brief, I'm checking my, just checking everything here. To give you a brief recap of what we've been talking about. We've been talking about this. Some of the basic ideas of macroeconomics, so I thought I would give you an overview in 5 slides or less after the weekend, and then we could push forward with what we're going to talk about today, which is a little bit about expectations, right, and the important role that they play, both in macroeconomics but also in microeconomics. So, we talked about aggregate demand, C plus I plus G, right, and how aggregate demand can actually be the origins of most of our problems. Well, missing wallet? I did not see one at the end of class. Got one there?
There is.
Oh, hey. Happy ending there. Good stuff. We found a wallet. Okay, so in any event, the problems come from aggregate demand, right? And, or this is typically how we initially thought about macroeconomics. They come from this deficient investment. Aggregate demand winds up being too low. Out of this, we had a couple of types of policy we might want to employ. The policies in general, you can think about them as leaning against the wind. So what does that mean? That means when the economy is underperforming, maybe because of insufficient aggregate demand, what we can do is prop up aggregate demand by spending more or taxing less, right? Of course, automatic stabilizers play a role in accomplishing this from the fiscal policy perspective. Monetary policy, well, we saw last time that we can stimulate investment, right, by lowering interest rates. And what we do here is we effectively expand the money supply. Easy money, right, is you might think about as the lingo for the policy, lowering interest rates and also impacting aggregate demand. So it looks a little bit like that, right? Fiscal policy results in a shift out in aggregate demand. There we have the change in E. Well, monetary policy could also accomplish a change. We might relabel it change in I, a change in investment, or even change in C, a change in spending, right? More money, lower interest rates, more investment spending at lower rates. And hopefully you remember how all that worked. So there was that. And the good news was that there was even, for however we conduct policy, there were these multiplier effects, right? So when we increase expenditures or make money easier, ease the money supply, make more plentiful reserves out there, well, this gives us an initial kick to the purple line, and then the multiplier effects, right? The circular flow basically starts rolling, and every dollar of new expenditures becomes some, $2 or $3 more dollars. It's a multiplier effect. So, once again, in a nutshell, the key idea is that when there's this gap, right, this difference between actual and potential GDP caused by aggregate demand and aggregate supply intersecting away from potential, we can close this gap, right? But I don't know if it's a complication, but it's also important to note that the gaps can close naturally, right? We saw that when you think about the economy being away from potential, the implication is that there's inputs out there that aren't being used, right? There's labor, slack resources, slack capital and land. All of those things are out there waiting to be used. We saw that what could happen is the price of these inputs should fall if they're freely available, and this should cause the gap to close naturally, right? And I describe this maybe as a ramification, I'll say, of Say's law, right? There should be an apostrophe there. Say's law, right? That supply creates its own demand. I'm sorry, 2 typos on one slide is too much for me. So let me just edit this one. Say, oop, that's not it. Oh man, I'm making it worse. There we go. So that's, that is what it is. The economy adjusts naturally, or we can adjust it through policy. You might think about the basic trade-off then being one about time, right? And in fact, I kind of said this in class. Well, how long does it take the economy to adjust naturally? If it takes too long, then we can jump in with policy. It's a little bit like when you get sick, right? And you say, well, I'll recover naturally. If I take some medicine, that might get me through the whole process quicker. It might have some side effects, but maybe I'll recover more quickly. Now, about those side effects, right? But first, I'll get to the side effects in a second. We can think about this natural adjustment process just using the diagram like this, right? So here we have a recessionary gap, aggregate demand and aggregate supply intersecting below potential. And what I've drawn here is aggregate supply shifting out, reflecting the idea that slack in input markets results in falling wages, rental rates, etc. And that will get us back to potential, right? And so one thing you might even look at is and someone asked me this actually in office hours, I think I forgot to say it, is that in some sense, if you had to compare the natural recovery, if you just got rid of that time element and you just had to compare this natural recovery with the policy option, you can see that one advantage here is that deflation occurs along with the recovery, right? Prices are lower at this new equilibrium after the natural process of adjustment, whereas with policy, prices are higher, right? That's a consequence of the difference between a demand and a supply shift here. So that might start to hint that there's other reasons why we might prefer natural adjustments, right? That we get deflation, which is a good thing, right, along with the adjustment. Okay, well, there are a list of other cautions. One of which is with fiscal policy, there are these considerable time lags, right? And in some sense, that is to say, oh no, we're in a recession, we realize it. Now we have to, get an act of Congress passed to get some more spending going. I mean, that could be if it's the beginning of the year, or if it's the beginning of summer, maybe Congress doesn't meet for a couple months, and so that's already, right, a delay in responding to the economic crisis. Of course, then we have to deliberate about how we're going to spend the money, how much, right? And indeed, we don't really know what the correct amounts are. None of them. We don't know what potential is. We don't know how big the gap is because we don't know potential. We don't know what the multipliers are, right? That is to say, we don't know how much each dollar we spend, how much additional spending it eventually creates. So there's a huge amount of uncertainty. It's a pretty crude device here. And so we don't even know if we want to do tax cuts, spending, whatever. And discretionary spending, we might not be able to even do that the way we want to because there's so much other spending going on, right? Social Security, defense, things like that. So those are all problems, right? Monetary policy, you might say, well, then that's the answer, right? We can, that's nice because the Federal Reserve, it's just those 12 people, right, on the Federal Open Market Committee. They don't have to work through the legislature, but it might make you a little uneasy, right, fiddling around with the amount of money in circulation. And you might say, well, does that really change things over a particular period of time? We talked about the quantity theory. Doesn't that sort of drive things over, any extended period of time? Maybe. It might make you a little bit uneasy. You might say we can't keep indefinitely expanding the money supply. We know where that goes. That just causes inflation, right? We have a lot of examples of that happening. So there are these other cautions, and it turns out there's even more cautions, right? One of which is crowding out, right? So government spending can actually cause higher interest rates, reducing investment. That's one type of crowding, right? This is a consequence of the fact that when we shift out aggregate demand, prices are going up, right? It's causing a little bit of inflation. But we might also just think a little bit about what's going on behind the scenes here as we kind of compare our two alternatives. Here, as prices go down, right, and aggregate supply shifts out, well, we're just sliding along the aggregate demand curves, which means that we're getting more investment, we're getting more consumption out of the people in our economy, right? If, however, we shift this out, if we do something to shift aggregate demand out, we're now at potential with higher E, and in some sense, if you sort of compare this outcome, right, being at the end result here, you compare that with this outcome, well, the implication is that now we have higher E, right, and we don't have higher C or I. Put another way, our government spending has now replaced some private investment. So that might be a concern as well. I guess it depends. I mean, you might even think about that as a good thing, depending on how you view these things. So, what I mean by that is maybe you think that we need some public investment, right? Like building infrastructure, building schools, things like that. Those are forms of investment. So you might not think of this as a bad thing. Yes?
But wait, if the government spending, don't that later on increase inflation?
Oh boy, we're going to get to that in a second. So the question was about if the government increases spending, doesn't that later on increase inflation? And indeed it might, for reasons that I only very briefly touched on here. In fact, we're going to have to, that's a great question, because we're going to have to think about things at a slightly deeper level here, hopefully, and hopefully you'll see what I mean here. So there's also this Austrian critique, and maybe this is a little bit like my medicine analogy. So Austrian economists, I talk about them at length, I guess, in my history of thought class. They're kind of a heterodox, out of the mainstream school. My opinion is that, nutshell, is that they make several interesting and intriguing points that you at least have to keep in your mind as you go through your careers as economists. One of which is that when we engage in government policy, right, increasing government expenditures and all that stuff to close gaps, we in some sense undermine the economy's natural ability to recover, right? It's a little bit like taking medicine every time you get a little sick. It's like in the end, maybe you wind up hurting your body's, I'm not a doctor, but, well, I am a doctor, not that kind of doctor. You might wind up ruining your body's natural ability to correct itself, right? So you might think about it like that. That might concern you, that, well, one of the important things an economy does is it frees up resources, right, for use in new industries or whatever. And if we constantly intervene, we interrupt that process. Okay. Well, another problem that often happens is monetization of debt, right? And this can be a problem. It's not so much a problem in the United States, I'll tell you why, but you might, if you ever take international economics or international finance, ECO 340 and 341, by the way, you can sort of see these sorts of effects emerge. The government deficit spends, right? How does the government do that? Well, the government does that by floating bonds, right? We talked about it last time. They sell you bonds, they sell other people bonds. That's how the government borrows. Well, what if the Federal Reserve, who has the money supply there, buys the bonds from the government, right? The government says, we want $100 billion in new spending, we're going to sell some bonds, and the Federal Reserve says, okay, we'll buy those bonds. So now the bonds go directly to the Fed gives the cash directly to the government, and the government spends it, right? So in some sense, simultaneously we're injecting cash and spending into the economy. It's pretty inflationary. You call this monetizing the debt, and it's a very big problem around the world, right? People have shown, in fact, that if the central bank of a country and the government are a little bit too cozy, the federal government, well, these sorts of things provide a very strong temptation, right? There's various names for this. And people often talk about seigniorage, which is how the government effectively can tax you by causing inflation, right? But you can see that this, could very easily be an inflationary relationship. So there was this neat literature for a while that showed that inflation rates in countries were higher where the central bank was less independent. So that's one reason why we have our central bank is independent from the rest of our government. Well, anyways, let's take a little bit of a look, a walk down memory lane here. We've done this a couple of times, but maybe we'll do it again and now emphasize different things. So before we had any of this macro, essentially economists just relied on, I guess, Say's law, the idea that supply creates its own demand. Once again, the Great Depression came along and it seemed like something happened here so that this wasn't working. We had these sorts of things that, we had this basic model that I've talked to you about macroeconomics. So we want to prop up the economy with government spending. If you think about your history a little bit, this happened in the United States throughout the Great Depression. We had the WPA, the Tennessee Valley Authority. We had these big government projects. In fact, if you walk around the city and you go to Highbridge Park or something, and you see these monumental staircases and all that stuff, a lot of them have a stamp, that'll say this was built in 1936, and it's kind of interesting. There's a lot of these things all over the city. Anyway, so there was that, but then of course World War II came along, and that was an enormous amount of spending in the United States, right? Government. That was a big increase in G, like we had never seen. So that happened, but then, 1945, the war ended. Many economists had this prediction that, well, now that the G is going away, right, we should just start up, the depression should start again, right? That didn't happen. And it turned out, why didn't this happen? Well, I'll get to that in a second. Continuing on, in the 50s and into the 60s in particular, we had an enormous ramp up in spending as well, right? The Great Society programs, Lyndon Johnson and all of that. And it didn't seem like it led to great sustained economic growth or being always around potential. So we had these mysteries, and then of course the 70s came, and that was a very strange time because we observed simultaneous inflation and unemployment, and really the only way we could explain that was by shifting aggregate supply, right, backwards. So supply shocks and these theoretical mysteries. One realization that came out of this, right, was that people behave dynamically, right? People behave dynamically, and I have some illustrations of this as we forge onward, not just from macro. So one example of this happening is in World War II. There was an enormous amount of price controls, right? Spending restrictions, things you couldn't buy. It was the war effort, right? I've actually been reading a lot about this and the price controls and sort of thinking about what happened when the price controls were relaxed. So one big thing, you may or may not know this, is we had national rent control during World War II and a little bit after. And I've been thinking about what happens to the various housing markets around the world or around the United States as the measures sort of disappeared. It's a really interesting statistical thing because they didn't disappear randomly. In New York, for example, they had a rule where if there was a certain vacancy rate in a county, you could get rid of the rent control. Otherwise, it would remain in place. So it's kind of a very interesting statistical setting to study this. Anyways, I digress. But what economists eventually figured out happened was that people, since they couldn't spend money during the war, saved it up and then spent it later. Well, where is that in our aggregate demand and aggregate supply model? It isn't there because the model is effectively static, right? We don't think about the future or the past as we construct this model. And economists then said, well, one thing we have to do is start thinking about this, right? The past and the future, and the fact that people think about these things. And this makes us a little bit uncomfortable as a profession, because not so long after we started thinking about these dynamical concerns in decision making, we realized that oftentimes people can defeat the purpose of policy by planning ahead for it, right? That is to say, people, when they anticipate policy, oftentimes they react in a way ahead of time that will nullify the policy. So we had this example here, right? We had this example here where we asked, I gave you the hypothetical worker example who sees that something that the Federal Reserve is going to do should increase prices in the future. And the question is, or the question we posed last time is, how do you react to this as a worker? And we said, well, most workers will perceive here that when prices go up, maybe because of some demand stimulus, that's like my real wage going down, right? If my wage is still fixed. So, right, and this, of course, it's interesting. We have a lot of this at CUNY because our contracts are very slow to, as faculty members, they're very slow to sort of update. So they're kind of fixed for a while. So when there's inflation, our wages go down, right? And that's kind of what goes on. And really what you'd like to do is you'd like to do something to take into account this inflation ahead of time, right? So one big example of this now is indexing. What does that mean? A lot of times, bigger corporations, wages are indexed directly to inflation, right? So every year you sort of see what inflation is and you increase everybody's wages. But we saw that what this could do is eliminate the effect of policy, right? And so we wind up with just inflation occurring from our policy, and it results in this general idea that people do not react naively to any sort of policy, right? And so this led us into expectations and forward-looking behavior as being this fundamental feature of any good macroeconomic analysis. Indeed, if you don't have this in your macro paper today, it's not going to fly, right, at virtually any professional journal, unless you have a good reason. So I can even show you kind of what we had in mind, and maybe even introduce some other things here to this picture. So we started here at this, here we have Y star potential. Here we have our price. Here we have aggregate demand. And maybe we have aggregate supply here. That's looking a little blurry, but let's see if I can make it better here. Might have to do the manual focus. This as good as it's going to get. And we said, okay, well, let's see, what if the Federal Reserve, say, expands the money supply, lowering interest rates? Well, what do we expect to have happen? Well, that would amount to a shift out in aggregate demand like this, right? And you can see that typically what we would expect is that we would move here, but then over time, at least as I've drawn the graph, we would expect that aggregate supply creeps back. So you might say, oh, we get a bump, and then it gradually goes away over time, right? Over time. If, however, people are responding to the policy, as I've described, rationally, right, maybe we don't even get a bump. When you see that aggregate demand is shifting out, you immediately adjust your plans, and instead we just go straight up here. So you can see the ramification here is that our policy has just created inflation. It's accomplished nothing in the real economy, just changed the prices and increased them. That's not so good. Now, one thing you might wonder here is, why did I start at potential when I was doing my policy, right? If I started away from potential, well, then we're good, right? So if I started my diagram like this, here's Y star, here's aggregate demand, aggregate supply like this, and now if the Fed does something, right, here's P and Y, if the Fed shifts aggregate demand by easy money, increasing the money supply, lowering interest rates and all of that, well, we could just wind up right back at potential, and then that's the end of the story. Interesting. So why would I draw my diagram like this when I'm arguing that policy might not be effective? Well, that is to say, why would we be engaging in policy starting at potential anyways? Well, you might say that one of the realizations that economists had in the 70s was not only that expectations matter, but also that supply is more important than we thought, right? And maybe it's the case that a lot of our problems are caused not just by shifts in demand, being too high or too low aggregate demand, right, as went with the standard Keynesian story, but maybe there are changes in supply that are doing this. And maybe, in fact, there are changes in potential GDP, right? It's hard to distinguish changes in, short-run supply and long-run supply. So what if it's long-run supply that's changing, driving fluctuations in our economy? So now potential goes down a little bit. I don't know, Suez Canal jam, bad weather, supply changes around, and we think it's a change in demand, but it isn't. It's supply. Well, then what I showed you there is operative, right? Everything we do as policymakers is just pushing us away from, or pushing us in some undeterminate way away from potential. So that freaked out economists as well, right? Once again, though, where does this leave us? Well, it's one of these things that you have to make your mind up about, right? I don't know if I've fully made my mind up about, where we are. Is it potential changing around? Is it aggregate demand? Is policy effective? Is it ineffective? Do people anticipate it? Well, tough questions. I would say yes and no would be my kind of take. You'll have to dig into this when you take Eco 201 and 301. Big subject, right? But suffice it to say for now that this forward-looking behavior is an important constituent of any economic model, and I'm going to describe one in great detail. It's from asset markets. Well, not that great detail, but we'll have an example in all of that. But it does make for difficult math, and I'm going to try to show you a little bit how that works today too. And this is kind of it's maybe a little bit of a pep talk, because as I don't know if I've probably mentioned this, I wasn't any great math student myself when I was in college until I started taking economics, and I was like, oh, now I have a reason for learning things. And then it sort of snowballed from there. Okay, well, these expectations, at least, and maybe I'll leave it at this, in terms of macroeconomics, we've talked about how people might anticipate price effects of policies, right? But there are ideas that they might sort of think about the fiscal consequences of policies as well. So there is this idea out there called Ricardian equivalence, attributed to David Ricardo, dressed up by an economist by the name of Robert Barrow for Modern Times. It's essentially that people sort of think about the fiscal consequences of any sort of policy that the government engages in. So an example might be if there's a tax cut, right? People say, well, that's great, there's a tax cut, I have more money to spend, but this means that in the future the government is going to have to raise taxes, right? Or do something else. And as a consequence, I'm going to react differently. I'm not going to spend as readily as I might because the tax cut, is going to be reversed in the future, and then I'll just have to pay more taxes then. So you might think of that as, you might think that's a little far-fetched, but people have actually demonstrated that people respond very differently to temporary tax cuts than they do, say, permanent tax cuts. One piece of evidence there. Okay, so Ricardian equivalence is kind of an interesting furtherance of these ideas. But let's take a little bit more about implications about these rational expectations. And what I'm going to do is spend a little bit of time with after macroeconomics, or maybe even over and above macroeconomics, these ideas of expectations turn out to have tremendous consequences for financial markets, and maybe even how you should think about your participation in financial markets. So here I have a very anodyne example of a stock. The price here is over 5 years. You can see that in year 1 the stock price was 8, in year 2 it was 8, and in year 3 it jumped to 10, 4, 5, 12, 12, right? And I'll pose a hypothetical thing. Let's suppose we have a year 6 here. I'll have this in my spreadsheet in a second. There's a year 6, and you can buy the stock. And you can buy this stock now, right? After this year 5 data came out, and then it'll have some value in year 6, right? And the question I'll pose to you is, what would you pay for this stock today, right? Before year 6 returns are realized, right? But you know everything up until year 5. What would you pay? Well, I think most of you are looking at this and saying, well, I pay something more than 12, right? But probably something less than 14, right? Where did I get that stuff? I'll show you in a second. But the way I arrived at that was, well, it's either gone up by 2 or it hasn't, right? And it hasn't gone down. So if I just sort of think about the past, progress of all of this, maybe that's how I would go about thinking about what the most I would pay today is, right? I do have this graph here. Let me zoom in a little bit. I've tried to make this a little bit more helpful, and I've added some additional data. So let me see if I can zoom in on this thing. All right. So here's that data, or a variation on that data. I've added a couple points just to make it a little bit more interesting. I have some other numbers in here. This is my technical analysis, right? By the way, something that you can do when you take eco-statistics or you take econometrics, you go way deep in the weeds in some of this stuff. Though maybe it's a little bit like karate or something where you can learn how to do it, but then once you have the power, you shouldn't use it, right? That's kind of where I'm going to go with this. So anyways, one thing you might do is here what I've done is I've plotted the actual data. It starts here and goes up and then stays there, and then, so you can kind of see where each of the data points aligns. Actually, maybe what I can do is fix this. There, that's better. So now you can see all the data there. And what I'm basically getting at is if you're trying to predict what you would pay for this, and let's put this here, in year 8, that works out kind of nicely, right? You can see that what I've done is I've said, well, we have our last data point here. All I want to do is extrapolate my trend, right? And then use it to predict the future, right? What I think the price is on average in the future. Now, of course, you know that it's not going to be that extrapolated value. It'll be probably, given the past history, it'll be 14 or 16, right? But this would be a reason. It's like any sort of gamble you might make, or any betting on any sort of coin flip. You try to figure out the expected value of said flip, right? And go from that. So that's kind of what you were doing here. And so one thing I can tell you here is what I've done in fitting this trend line and predicting that. I'll I'll show you here. So there's this thing here. This is called lin est. See the up there in the fx equals lin est. What I've done is fit a line, a best fitting line through my data points, right? So my x values are the years. See A2 through A8, 2, 3, 4, 5, 6, 7. My y values are the stock data. And using this simple little routine, right, in any spreadsheet, you can fit the best possible line through your data. It's called a linear regression. It's a workhorse tool in statistics, in economics, in anything. And if you ever wind up in any industry out there using your economics, more on that later, you'll do a lot of linear regressions, right? And in fact, it becomes your sort of go-to technical tool with some caveats. If you wind up taking Professor Deb's classes, for example, or if you take, say, health economics, you get obsessed over whether or not your linear regression is in fact a causal relationship, right? Whether or not your x is causing your y. Here we're just doing a time trend. So anyways, that's what I used here. And you can see here that what this equation, what these two numbers mean after I put in this lin est, right? It actually creates both this and this. I can show you here. I'll do it live. Copy. Oop. Now I want to do B2 through B8. Let's change this. A2 through A8. And that's where I get it's just a simple command that fits that line. And so the way you probably know the way any line works is it's a constant, right? A line has a intercept and a slope term. Well, the first term here is this is the slope, 0.85, right? And this is the intercept, right? 7.71. And so when I want to compute what I think the price is in the future, I use that formula up there. I take the intercept, 7.71, and then I just multiply it by, I want to multiply this a little bit wrong in this formula here. I want to do $B, $16 times $A, $16 times 8. That's the year I'm interested in. And so you can see here my predicted price using this high-tech, sophisticated analysis winds up being 14.57. So that might be a sophisticated guide to what you think the stock is going to be in the future, and that would therefore be the most that anybody would pay for it today, right? And you can even see that 14.57 lines up pretty well with what I have on my graph there. Right? It's somewhere between 14 and 15. You don't have to understand all of that, but hopefully everybody's with me here. Kind of see what's going on here. This is technical stock analysis. I know it's a highly stylized example, but okay. But now what if I told you instead, right, rather than just looking at the data and all of that stuff, what if I told you exactly how I made the graph, right? That is to say, what if I gave you direct insight to make it sound even more impressive? I gave you insight into the data generation process, right? So I tell you how I made the data. Put another way, I tell you the model. And here was how I made the data. With a probability of 1/2, the stock price will increase every year by 2. With a probability of 1/2, it'll stay the same as before, right? So what would you pay for the asset now? And what does that say about all of this stuff that we did, right, that we used to extrapolate for this line here? Well, my contention is what you would pay for the stock would change pretty dramatically. You would pay something more than 14.57, right? You would probably pay 15, right? Well, why would you or pay anything up to 15? I'm sorry, I should say it that way. Why is that the case? Well, you know how I made the data. You said, well, I know what Baker's going to do. This whole trend line doesn't matter. All that matters is that today the price is 14, right? And he's going to flip a coin, and if it's positive, if it's heads, he'll add 2 to that. If it's tails, he won't add anything to that. So the price is going to be 14 next year, or 16, each with a probability of 1/2. So the expected value of the stock is 15 today, right? Because 1/2 times 2 plus 1/2 times 0 plus 14 just gives us 15. Interesting. Now, This is a version of what we can call the so-called efficient markets hypothesis, right? There's actually different flavors of this, and I'll get into these. And that is to say, people rationally predict how asset prices over time evolve, right? It also means that what you can't really do is look at the past behavior of a stock price and predict its future value, right? The only thing that really matters is what the stock price is today, right? All the past history is in that price today, right? You might think about it that way. Everything that I did before just gave me the price today, and now all I have to do is think about what's going to happen over the next year, right? And so when people know that that's the model, it changes their behavior, right? In a rather dramatic way. And so the efficient markets hypothesis basically extends this logic to asset prices in general, right? And maybe the most direct consequence about this is the hypothesis says everything that we know about a stock company today is already in its value, right? So only news, only changes, right? New things that happen, right? My coin flip being realized will change the price today. If I flip the coin and it comes up heads, and I say I'm going to add $2 to the price of the stock in the next year, now you know. And you would pay up to 16 for it in my example today, right? Because you know its value is going to increase by 2. No longer 15, but 16, once the news is realized, right? And so that's what drives stock prices over time is new news, right? Maybe that's redundant, but I'm emphasizing the idea that that's the only thing that can change, right? And so one thing you might think about is what consequence this has when you look at a stock price. Well, it turns out, here's the Dow average, which is kind of all, a measure of all stock prices. If you look at this thing, you can see that, well, it changes in the, a month ago, blah, blah, blah. But it looks more or less like what you might call a random walk, right? It's just a noisy graph that bounces up and down. Well, that's one of the consequences of this efficient markets hypothesis, right? So I talk a little bit about Amazon. Maybe I should start by saying Amazon is one of the world's, very productive firm. It generates a lot of wealth. Do I recommend that you run out and buy Amazon stock because you're going to get a great deal or a great return on it? The answer is no. Why is that? Because it's already very expensive, which reflects the idea that Amazon has been very productive and people think it will into the future. Yes?
If we already have Amazon stock, are you saying to sell?
No. I'll have specific advice in a second, right, about that. I'll have my one bit of financial advice here in the class. But the point is that I can't really tell you because the only thing that will change Amazon's value up or down are things that none of us know yet, right? New pieces of news, like coin flips being realized. So one neat illustration of this is actually if you go back in stock market history and you look at the Amazon price in its early years. So Amazon became public in 1997. I remember I created my Amazon account in like 2000 or something. And there was all these news articles about how Amazon, everybody's like, it's not profitable, it's not going to make any money. Yet somehow people were still buying the shares in the company, even though they had never once reported an actual profit, right? It had never once been the case, circa 2000, that Amazon had ever, in its entire history, made profits. So public in 1997, the stock price was 78 cents. They had about 7 billion shares out there. If you multiply the stock price and the shares, you find that the market capitalization, that is to say the overall value, market value of the firm, was about $5.5 billion, which is not nothing, right? It's certainly a really high number for a firm that has never made money, or you might think about it. Why were people doing this? Because they expected that in the future Amazon was going to make a profit, and of course they would have been right in this assessment. So this efficient markets hypothesis, when you start taking classes like securities and investment analysis and corporate finance, things like that, if that's what interests you, you'll learn that there are different versions of this efficient markets hypothesis, and they basically center on what we're assuming is known about a stock, right? And so the weakest version, right, the one that makes the least amount of assumptions, is that past prices and volumes, right, if you look at all this past data from the stock, you can't use it to predict the future price, right? You can't use past information about a stock to predict what it's going to do in the future, right? And indeed, that's exactly what my example here suggested, right? Was that everything kind of about this is an illusion, right? The linear trend doesn't help us. All you need to know is the price at the last point in time, and then some information about the statistical properties, if I want to say it in a sophisticated way, something about the statistical properties of the series. Other than that, nothing's going to help you, right? Predict the stock. So past prices, volumes can't predict things. Well, why is this the case? Well, public information about the stock is common knowledge, and everyone has already incorporated it into the price, right? All that stuff is already in there. So one implication of this is that this technical analysis that you see people do, right, where you do the sophisticated look at, trends and, momentum and all that stuff surrounding a stock in the past, that's going to be useless in trying to predict the stock price, right? You're not going, put another way, you might make a little bit money here and there, but what you're doing is essentially gambling, right? You can't systematically, I should say, make money. But you might say that, okay, well, Baker, maybe I'll accept that, but why do I just have to use past information about this stock? Maybe I can engage in what is called fundamental analysis, right? And this is where you think about other things, other underlying characteristics of the economy, right? Like the rate of GDP growth or gas prices or something like that, right? You use these as fundamentals as drivers of different stock prices. Well, the so-called semi-strong efficient markets hypothesis says, well, if we parlay that logic that I just described for you, anything that is already known, that also can't predict future prices, right? For the same reasons. So the implication then is that only private or specialized knowledge can give you an edge in the stock market, right? So you have to know those things to really systematically make money. So, or, you're doing some cost benefit thing. I'll talk about that in a minute. You might say, well, how do day traders make money? I might say, it's kind of gambling, and they take risks, right? Whenever you can get higher rates of return in a market, but you have to take on a corresponding cost, and that's usually bearing risk. So only private or specialized knowledge can give you an edge. Well, the strong efficient market hypothesis says, well, not only that, but also all public and private information are in the current price, right? So how does this work? Well, you might say that there's some rich guy out there who does all this technical analysis. He has a very high demand for Amazon, and his demand is propping up the price. Therefore, everything he knows about the stock is already in the price, along with all those public things, right? So the market consequences, I guess you could say, of private information might also mean that is even a lost cause. So if you put all this together, you wind up with an implication that if you're trying to do better than the normal market returns over time, you're sort of on a fool's errand. But of course you have to believe these different versions of this hypothesis. Of course it's a hypothesis, and one thing that we want to do, or we strive to do, is test hypotheses, right? To see if they're in fact really true. You can make the argument, you can do all the theory out with a pencil and paper. Does it work in theory? I mean in practice, right? So a little bit of summary of the evidence. The weak efficient market hypothesis, it seems like it generally holds, right? There are these things, there are these behavioral effects, however. This is a new thing, by the way, the field of behavioral finance and behavioral economics. So we offer a course in behavioral economics. Karna Basu has taught it in the past. Very popular. And people have learned that there are these various anomalies that are sometimes documented. There's these momentum effects, right? That stocks that trade a lot, maybe you can find something there, some predictive value there. There's mean reversion, the idea that stocks that are way above their historical trend have a tendency to come back down. Calendar anomalies, right? If you sold your portfolio on Friday and bought it all back on Monday, maybe that might do something. And of course, you might say that these are really just kind of artifacts of the way people behave. Like, we're not completely rational beings. In fact, people have shown that the more you interact in a particular aspect of a market transaction, you become more rational. But there's a lot of us out there, you do some transactions that you just don't do that much. And it's hard to be rational and consider all the information. So for example, if you ever get married and you have to buy an engagement ring or something like that, you do that maybe, once. I'm still on my first marriage, so yeah. So I've only done it once in my life. I had no idea what I was, that was a bad joke. I have no idea what I was doing when I was buying a ring, because I just never do it. But if I was, one of the people in Midtown there buying and selling diamonds, I might have a very firm idea as to what a price of a diamond looks like, how they're going to change. So people get more rational over time. But anyway, so, and one interesting example of this, I always find this interesting, is, and I saw this in a paper somewhere, I couldn't find it, is the places where people buy their lottery tickets, right? So you go to buy a lottery ticket, it turns out that people often go to places that have sold winners before, right? So you go buy your lottery ticket at a place where they had sold a winner before. Why? There's no statistical or actual reason why you would do this. Right? No location is more likely to produce a winning ticket. People just do it because we do things like that. Okay, now the semi-strong hypothesis, same kind of thing, right? What is the evidence for it that it in fact works? Well, we do a lot of these things called event studies, which are really cool. We have our master students do a lot of them for their theses. And so what is this? Well, you look at sort of a random price over time and you study in a particular event, right? Like a Fed announcement or something. And then you see what happens to the price when the Fed makes its announcement, right? And then you see how that particular event changed the course of this stock. So I had a student many years ago who was working on one of these, and he was looking at beer ratings. And it was basically what happens when a major brewery buys a small microbrewery, what happens to the ratings. And he did an event study of that, and so was going to. So those tend to affirm this idea that public information generates a very quick reaction in a stock price. So that's some evidence for it. The other piece of evidence, more on this in a second, is that it turns out that active managers, right, so people who manage portfolios actively and buy and sell a lot of stocks, they typically wind up underperforming. And what does that mean? I'll show you in a second. And so, of course, the same anomalies, though, we do observe, that there are these anomalies in certain stock prices. So that's some evidence against. Strong form of evidence, or strong form of the efficient markets hypothesis. Some people have suggested that, one good piece of evidence for this is that institutional investors, right, these are, unions or, people managing retirement funds, they invest enormous sums of money, and so you might expect that they have some information about stocks that we don't, right? But it turns out that most of these institutional investors don't seem to be able to do better over time than your average Joe investor. But there is some evidence that suggests that maybe this doesn't hold. So that, believe it or not, there have been studies done of how insider trades work out. And it turns out that if you can engage in insider trading, you can actually do quite well. You can beat the market, so to speak. Maybe that's not a surprise. Of course, that's illegal, so I don't suggest you do that. And then, of course, there's also the market anomalies. But there is one interesting take on all of this, and I'll show you this here. Let me see if I...
You'll be underwater. You'll be losing money. In other words, the dividend gain is not worth the principal loss. Whoa, I can't take the pain. That's when you want to be a buyer.
The world of investment advice is a crowded and noisy place. The good news is you can turn down the shouting. And you also don't have to follow stock quotes minute by minute in order to be a smart investor. In the next few videos, we're going to lay out some rules for smart investing. No, we're not going to tell you how to get rich quick, but we will give you some good advice for getting richer slowly and steadily. Now let's start with investment rule number 1. Ignore the expert stock pickers. What if I told you that a blindfolded monkey throwing darts at the financial pages could select a basket of stocks that would do just as well as one chosen by the experts? That was a controversial claim made in 1973 by economist Burton Malkiel in his book, A Random Walk Down Wall Street.
Great book, by the way.
Years later, one of his undergraduate students turned out to be journalist John Stossel. And Stossel, he set out to test this claim. Now, blindfolded, dart-throwing monkeys, they're not easy to come by, and the lawyers are a little bit worried, so Stossel threw the darts himself.
My darts landed on 30 companies. How would they do compared to stocks recommended by managed mutual funds? Oops, better.
Sure, Stossel got lucky on his throws, and he reaped high returns. But the lesson here turns out to be correct. Random picking does just as well as the professionals. Let's take a closer look. Most people invest in the stock market by buying a mutual fund, a portfolio of assets like stocks and bonds managed by professionals. There's thousands of mutual funds. Some of them are actively managed. They have experts picking stocks and charging fees. The other type of mutual fund is called a passive mutual fund. Passive funds don't try to pick winners or avoid losers. They simply invest in a big basket of stocks, such as the S&P 500. Now this chart shows the percent of mutual funds that were outperformed by the S&P 500. You can see that in most years, the S&P 500 beat a majority of the actively managed mutual funds. Okay, so perhaps you're thinking, I got it. Most mutual funds don't beat the market. But what if I invest in the ones that do beat the market? The problem with this strategy is that the funds that beat the market are different every year. In other words, past performance does not predict future performance. The funds that beat the market this year, they probably got lucky. And they're unlikely to beat the market next year. In fact, one study looked at the 25% best performing funds. How many of these funds were still top performers just 2 years later? Less than 4%. And after 5 years, only 1% of the initial top performers remained in the top quarter. So funds which are great this year, they're probably not going to be so great in the future. They probably just got lucky. Okay, well, what about those very, very few funds that do beat the market over many years? Hasn't Warren Buffett, for example, the world's most successful investor, hasn't he shown that you can beat the market? Maybe. There's no denying, Buffett's a very smart guy. He's made some very good choices. But it's actually harder to distinguish luck from skill than you might imagine. Let me explain. Imagine that we started with 1,000 so-called experts, except all the experts do is flip a coin. Those who flip heads say the market is going to go up this year. Those who flip tails say the market is going to go down this year. At the end of the year, 500 are going to be right, purely by chance. Now suppose that those 500 then flip the coin again and they make a new prediction. At the end of the second year, 250 of these so-called experts, they'll have been right 2 years in a row. Again, purely by chance. Now keep going with this logic. At the end of 5 years, just 32 of the original 1,000, they will have been right about the market 5 years in a row. Now these 32, they'll probably be labeled market geniuses. They'll show up on television. Their services will be in high demand. Perhaps some of them will write books about how to predict the stock market and get rich quick. What the laws of probability tell us, however, is that out of the initial 1,000 experts, about 32 were going to predict the market correctly no matter what the market did. So are some market geniuses truly skillful? Sure. But it also helps to be lucky. And it's sometimes not obvious which is more important. In recent years, in fact, Buffett's investments haven't done all that well. So lesson number 1 is ignore the people who shout stock tips at you.
Dividends funded by debt and non-excess free cash flow
He's the worst.
are just too risky to own from now on.
And definitely don't pay big bucks for professional money managers. Well, what if you have some information about what looks like a great investment? Can you beat the market? Well, we're going to cover that and the efficient market hypothesis in the next video.
Check out our practice questions to test your money skills.
Okay, so hopefully you get the idea. It's kind of an interesting take on this. So I might even parlay this into my investing advice, which is to stick with those mutual funds, right? And invest early and often. You know, you won't get rich, as the video suggested, quickly. It'll take some time, but there's some good news there too. Time goes by much faster than you think it will, right? Maybe that's depressing, but I don't know. Some investor said that, but that's essentially all of my advice. Yes?
Can you invest in an ETF who also invest in those same stocks and make it a lot better than going with a mutual fund?
I don't know. I mean, so one thing I will say is theory would suggest that other things equal, no. But one thing that also matters is risk properties, right? And so oftentimes, like I say, you can get a higher return on average by taking more risk, right? There's a trade-off there. You learn about that when you take securities and investment classes. So I've seen a fair number of presentations, where people have some algorithm for predicting future stock prices, and then they generate some predictions out of sample and show that they've made a big return relative to the market. Well, oftentimes they haven't talked anything about the coincident risk that they've been taking, right? And you really have to kind of think about those two things, volatility and outcomes. So just one last thing here, a couple last little bullet points here. Please take a crack at your teaching evaluations. We take them seriously. If you want to ensure that Baker doesn't cause any more damage than he already has over the years, you can put that in your evaluation. Take a crack at all the practice materials. Let me know if you have any problems with those. You have to upload the GradeScope stuff if you want it graded, and before Thursday, Wednesday afternoon maybe. And also I hope that you'll continue and take some more economics classes and maybe even consider an economics major. I can give you a brief sales pitch here. And that one thing that I like about economics, maybe you've gotten this a flavor of this, is that it does tend to be a STEMmy technicals type major, right? You have to take calculus and statistics. But you can kind of take that math and statistics anywhere, right? Employers like it when you know math, when you know letters math, numbers math, and graphical math. And you can study just about anything you want to with it, right? Philosophy, history, but there's also finance, development, health. And just about everybody employs economists. So I'll let you look at the career outcome stuff. But two things I'll mention about this. One of which is, this is generic advice for college students in general. Don't chase good grades, right? Rational expectations. If you jump into a major just because everybody gets A's all the time, that's known to employers. They all know it. They know it doesn't mean anything, right? So think about your rational expectations there. The other thing you can think about is, well, I like philosophy. If I do economics, how am I going to make any money doing economics? Well, it turns out professors aren't paid that well in general, but economics professors tend to be fairly well paid. Why is this the case? Well, once again, it's arbitrage and rationality. Because an economist can make money somewhere else, they have to make a certain amount in the academic sector. So you can use your economics to think about reasons why you might want to become an economics major. Of course, the career outcomes tend to be pretty good. So I'll leave you to think about all of that, and I'll see you on Thursday for our big review. Get out a little bit early here today. That's fine.